So welcome everybody. Today we're going to talk about a really fun subject. The greatest financial crisis in history is coming. Now everybody's looking forward to hearing about this. I know it may not be the most fun thing to think about, but we're going to talk about what the Bible says you can do to prepare and what we need to make sure that we're doing to prepare spiritually for what is coming. So, for those that don't know me, whoops, I may be locked up here. Sorry. There we go. All right. So my name is Britt Gillette. For those that don't know me, I've been studying Bible prophecy for over 30 years. I'm here this weekend with my lovely wife, Jenny, and we live in southeastern Virginia with our 3 children. The author of 4 books on Bible prophecy, and you can find articles and videos that I put out on brittgillette.substack.com. That's the best place to find me. You can direct message me there if you want to. So, we're going to talk about the greatest financial crisis in history is coming. This isn't a matter of if it's coming, it's just a matter of when it is coming. And to fully understand why that is, we have to turn back the clock to this date, August 15th, 1971. So on that date, President Nixon issued an executive order ending the convertibility of the dollar into gold. At that time, other nations could convert their dollars into gold at an exchange rate of $35 for an ounce of gold. Now, to put that in perspective, today, if you want an ounce of gold, you'll have to trade over $4,000 for it. That means the purchasing power of the dollar has declined 99% since this date right here. And this was very important because Bretton Woods, this was a conference that was convened by the Allied powers in the middle of World War II, July 1944, that set up a monetary system for the aftermath of the war. It was called the Bretton Woods Agreement. And under this agreement, the United States was to back the dollar with gold at that rate of $35 per ounce. It was to be convertible by the other nations into gold at that price. And the other allied nations, the industrialized nations of the world, said, we're going to peg our currencies to the dollar. So in effect, it made every currency in the world, it put every currency in the world on what's called a gold standard, which meant that the currencies were restrained from being printed into oblivion. But on this date, when Richard Nixon issued that executive order, he effectively ended the Bretton Woods Agreement. That monetary system ended. And at that moment, the dollar became what's called a fiat currency. And what that means is it's not backed by anything. It's not backed by gold. It's not backed by silver. It's not backed by anything real. It only has value because the government says it has value. And because all the other currencies have been pegged to the dollar, it meant something happened that had never happened in world history before. All at once, every currency in the world became a fiat currency, meaning they weren't backed by anything. And that's a problem because fiat currencies always return to their intrinsic value. What is that? Well, it's the paper and ink that they're comprised of. Here's an example of a fiat currency. This is the German mark post-World War I. So prior to World War I, the German mark was convertible into gold, and it maintained a steady value. After World War I, they ended that convertibility into gold. They had massive debts. They were required to pay reparations, so they said, well, we'll pay the reparations with our printed currency. And they just printed the currency. And here you see on the right, you can see children building a tower with blocks of currency. If they had had that currency a decade earlier, they'd have been extremely wealthy. But here, it's pretty much worthless. We have a man with a whole wheelbarrow of it. There's a famous story of a woman who had a wheelbarrow of German marks, and she went to the bakery with the wheelbarrow. She went inside. While she was in there, somebody stole her wheelbarrow, and they left the currency. Because the currency was worthless, but the wheelbarrow had real value. So eventually, all fiat currencies return to their intrinsic value, which is pieces of paper. And so with no gold to restrain the printing of a currency, the printing presses run wild. And again, that's what we've seen with the US dollar since 1971. As soon as Richard Nixon issued that executive order, we saw massive inflation in the 1970s. We saw things stabilize to lower levels of inflation for a time, and then something else happened. So this here is a chart from the Federal Reserve Bank of St. Louis. It charts what's called, they call it M2 money supply. It's more accurately M2 currency supply. And it basically tracks the number of dollars in existence. And for almost 200 years, this was relatively stable. And then we see in the 1960s, it started to edge up. And then we see, well, something happened around the year 2020. We see this huge inflection point. It almost goes vertical. In response to the pandemic, the government decided they were going to bail out banks, they were going to bail out all these corporations, started printing dollars. Between February 2020 and February 2022, 40% of all the dollars ever created were created. And when you have more currency units pursuing the same amount of goods and services, it takes more currency units, or it takes more dollars. So prices go up. So this explains why prices at the grocery store have gone up, why the prices of almost everything we need have gone up. But this currency didn't just chase groceries or car insurance or all the other things that we need in life. It also chased assets, stocks, bonds, real estate, cryptocurrencies. And what it has done, it has blown the biggest speculative bubble since 1929, and I would argue the biggest speculative bubble ever. And it will end in similar fashion. Let's start with the stock market. Let's take a look at this. This is a chart called the Buffett Indicator. This is named for Warren Buffett, who's one of the most famous investors in the world, multi-billionaire, renowned for his wisdom of the markets. And he came up with this formula, which takes the top 5,000 stocks in the United States and divides that by the total economic output of the nation. According to Warren Buffett, fair value should be about 60%. Anything below that, well, it's a bargain. Anything above that is overvalued. Right now, as you can see on the right, we sit at an all-time high of 220%. Never, ever has the US market been this overvalued. In 1929, it didn't come this close. You can see in the middle, that little bump there, that is the dot-com bubble. And then there's an even smaller bump right to the right of that. That is 2007, right before the great financial crisis, when we saw markets fall 50%. Now we're at heights never before seen on this. Here's another chart. This shows the S&P 500. So this is what most people invest in their retirement accounts. As they say, well, I'm invested in the S&P 500. I'm going to put my savings in that. Well, according to this valuation metric, this looks at the price of that relative to the sales of those companies. Historically, this ratio should be 1 to 1.5. Right now, it's about 0.02% away from the all-time high that was set during the dot-com bubble. Again, historic overvaluations. We also see this, which is concerning. So this is the top 10 stocks in the S&P 500. Again, the S&P 500 is what most people invest in their 401ks and their IRAs and their retirement accounts. Their pensions invest in this. They go, well, I'm going to buy an index fund. I'm going to buy a mutual fund. Oftentimes, it's buying the S&P 500. And most people think in their minds, well, that means my life savings is being equally divided up against these 500, within these 500 companies. And so that means I'm diversified. That's a good place to be. But there's a problem. The S&P 500 isn't equally weighted. It's a weighted index that's tilted toward the largest companies. That means here we see the top company in the index, NVIDIA, makes up 7.5%. So if you put $100 into the S&P 500, $7.50 of it goes into NVIDIA only. And those top 10 stocks make up more than 38% of the index. Guys, this is a big, big, big problem. And this is why. The Bible tells us, bad idea. This is from Ecclesiastes chapter 11, verses 1 through 2. It says, send your grain across the seas, and in time profits will flow back to you. But divide your investments among many places, for you do not know what risks lie ahead. The Bible says we should be diversified. This shows us we are not. You ignore the wisdom of the Bible, you ignore the Word of God at your peril. There will be a price to pay for this. There will be a consequence as a result of ignoring what the Bible says to do. Not only do we have this excessive concentration in those top 10 stocks, but if we look at the valuation of those stocks, we see something even more concerning. So here we have two metrics that are commonly used to determine whether a stock is undervalued, fairly valued, or overvalued. We have the price to sales ratio, and we have the price to earnings ratio. Both of those are at unprecedented highs for these 10 stocks that make up 38% of the S&P 500. Now, let's look at this price to sales ratio. It's 12.8%, or 12.8 right now, 12.8. That is absolutely absurd. How absurd is that? Well, let's just ask this guy right here. So who is this guy? This is Scott McNealy. He's the former CEO of Sun Microsystems. Sun Microsystems was a high-flying stock in the middle of the dot-com bubble, right? And it went to the moon. Everybody said, oh, Sun Microsystems is part of the internet future, and the internet was part of the future. But that doesn't mean that it justifies any valuation for internet stocks. So not long after the dot-com bubble burst, he gave a famous interview where he said this. He said at 10 times revenues, and he's talking about that 10 times sales number we looked at, which we just pointed out, it's 12.8 for the top 10, not 10. It's even worse. It's 28% worse than what he's talking about here. He says at 10 times revenues, to give you your payback, so for you to get your hard-earned life savings back after 10 years, I have to pay you 100% of revenues for 10 straight years in dividends. That means no cost of goods sold, you can't have a building, you can't have employees in it, you can't pay for utilities, nothing. Every single penny that comes into the company in revenue has to go right back out the door to investors just to break even. He says, now having done that, would any of you like to buy my stock at 64? Do you realize how ridiculous these assumptions are? What is he talking about? Well, he's talking about this. This is what happened to the price of Sun Microsystems. So that big mountain peak we see is the middle of the dot-com bubble. Sun Microsystems hit a high of $64. That's what he's referencing. And Sun Microsystems was a profitable company. The internet was as revolutionary as everybody thought, but Sun Microsystems was ridiculously overvalued. And eventually it went from 64 back to its pre-bubble price of $5. That's a 90% loss. And it had a price to sales ratio of 10. Right now, the top 10 stocks that comprise 38% of the S&P 500 have a price to sales ratio of 12.8. That's 28% higher than this was. Expect an outcome that's similar. And guys, it's even worse because back in 1929, prior to the great crash of '29, we saw people engaged in something called buying on margin. What is buying on margin? Well, it meant that somebody said, well, I'd like to own 10,000 shares of General Electric, $10,000 of General Electric. But all I have is $1,000. But my broker will lend me $9,000. Now I put my $1,000 with it, and I can buy $10,000 worth of General Electric. That sounds great. And when it goes up, I'll sell the stock. I'll pay them back their $9,000. Now I'll make a big profit. Well, that's great if the stock goes up. But if it goes down, then the broker says, give me my $9,000. And you go, well, the stock went down. I don't have it. And then they say, well, we're going to sell it at a loss. And then we're going to come and we're going to take your house. We're going to take anything we can get from you. You owe us $9,000. So many people lost everything they had because they bought on margin. Today, we see margin buying at all-time highs, and we see something even worse because back then, they didn't make use, like they do today, of something called options. So options operates very similar. They're these contracts, and I say, I want to buy a contract from you that gives me the option to buy a share of stock at a certain price. And so if I want to own 10,000 shares of General Electric, but all I have is $10,000, all I got is $1,000, well, I can buy some options to buy it, right? And I put a little bit down, and if it goes up, wow, I'll make big outsized profits. It's called a call option. The number of call options being used right now, the volume of this is at unbelievable, unprecedented highs. These are 4-week moving averages that show that right now 40 million of these contracts daily are traded. We've never seen this before. And on top of that, it gets even worse because we're seeing something called zero DTE options. What is a zero DTE option? Well, that stands for 0 days to expiration. Well, what does that mean? That means, well, it expires at the end of the day, the trading day. So at the end of the trading day, it's worthless. 60% of S&P 500 options volume is in these types of contracts that expire at the end of the day. Guys, that's not called investing, that's gambling. That's people saying, I'm gonna make a wager that a stock price is gonna move in a certain direction. The market's gonna move in a certain direction. It's not based on any analysis that anybody's done. It's not based on anything these companies are doing. It's just people gambling. And we see the same thing in the NASDAQ. We see there 80% of the NASDAQ options volume is these contracts. This is leverage that dwarfs anything we saw in 1929. Now, if there's any doubt of how overvalued the market is currently, let's go back and look at that top stock in the S&P 500, NVIDIA. At its current valuation, NVIDIA by itself is the 4th largest stock market on the planet. Only the United States stock market, China, and Japan are bigger than the single company, NVIDIA. That means the market says, well, NVIDIA is worth more than every publicly traded company in Germany, the 3rd largest economy in the world. We'd rather have NVIDIA than all of those companies. We'd rather have NVIDIA than all the companies in France. We'd rather have NVIDIA than all the companies in South Korea or all the companies in the United Kingdom. This is an absurd valuation. And again, it's not just the stock market where we're seeing this bubble. We're seeing this in cryptocurrencies as well. You've heard of lots of people trading cryptocurrencies. They say, well, this is the next big thing. But much of it is just gambling. Doesn't mean all of it is, but most of it is. Here's an example. This is called Dogecoin. This is where Elon Musk got the idea for DOGE, Department of Government Efficiency. It was based on memes that he was spreading on the internet a few years ago. All over Twitter, people were talking about Dogecoin's going to go to the moon. That's that big spike you see there. Well, what is Dogecoin? Well, this is a cryptocurrency that was created by two friends as a joke, because they looked around at people who were putting their hard-earned life savings into cryptocurrencies that had no value, and they said, let's create one, and we'll put your dog's face as the mascot for it. Call it Doggy Coin, and then people called it Dogecoin. It has no value, it has no use, and we see all along from the left all the way until around 2020, the world treated it as it was, as a joke. It had no value. Then all of a sudden, we had all this massive dollar printing, and now all of a sudden, it's going wild. Why is that? And when I took this snapshot, I believe on Monday, it had a value of $38 billion was in Dogecoin. A coin created as a joke. At its top, back in 2021, it was $100 billion. Think that's just an isolated example? How about this? I don't have to say much, do I? This is another joke meme coin. Fart coin. This has no value whatsoever. Nobody's going to use this for anything. But right now, well, when I took this snapshot on Monday, it was worth $681 million. I checked this morning, it's down 50% since Monday. This is gambling. It's not investing. This is gambling. There is no value here. Yet, many people have taken their hard-earned life savings and they're buying this. Why? Why are they doing that? Because it's gambling. They go, well, it's going to go up. Somebody else will pay more for it. There's no reason for anybody to pay more for it. They just hope. They hope somebody will pay more for it. It's not just cryptocurrencies. We see the bubble in housing. So here we have the median home price compared to the median income. How many multiples of your income does it take to buy a house? This should be between 3 and 4 times your income historically. At the height of the housing bubble, this was 6.73 times your income. That's the same housing bubble that led to the great financial crisis that almost destroyed the entire global financial system. Today, it's at 7.36. So it's higher than the housing bubble we saw before the great financial crisis. Here we have a chart from Nick Gurley on Twitter where he talks about that very same thing. He says, the orange line, he says, housing is unaffordable when the orange line is higher than the blue line. So this shows how much income it takes to buy the median house price. See, we can see if we look a little bit to the left of the top of that chart, we'll see that orange line pop up above the blue line. That would be the housing bubble that led to the great financial crisis. And you can see where we are now. Guys, all of these bubbles will pop. It's just a matter of when. And some people would say, no, you're wrong, Britt. That's not the case. Because the economy is going to grow. The global economy is doing well. It's going to grow. We're going to grow our way into these valuations. And therefore, we shouldn't expect these bubbles to burst. Well, let's look at that. So let's start with China. China is the second largest economy in the world. But China has a problem. For decades, China built things like this. This is a city that nobody lives in. But it employed a lot of people. There's another city that nobody lived in. But again, it employed a lot of people, kept the economy humming along, and now China has been paying the price. So they've had a real estate crisis for the last 4 years. In the last 4 years, China's real estate market has lost $18 trillion in value. To put that in perspective, In the great financial crisis, the US real estate market lost $12 trillion. So they've already lost 50% more than the United States lost during the whole of the great financial crisis. How about the world's third largest economy? Can they grow us out of this? Well, Germany also has some problems. So prior to Russia's invasion of Ukraine, German industry thrived on inexpensive and freely available energy, natural gas and oil coming in the door. But once that wasn't available anymore, they started to have problems. So this is from back in the fall of 2022, so about 3 years ago. And this just really caught my attention. You had 4 companies, all 125 years old in different industries, and they all failed on the same day. Now, I want you to think about what that means. 125 years or more old. That means all of these companies survived World War I, the Weimar Germany hyperinflation that we saw pictures of at the beginning of this, the Great Depression, the rise of Adolf Hitler and the Nazis, World War II, and the complete destruction of the entire nation in the aftermath of that war, and then everything ever since. But on one day, 3 years ago, they all went bankrupt. Why? Well, Germany no longer has access to the cheap energy they once had access to, and it's destroying their economy. They are deindustrializing. Companies are moving abroad where they can get available, cheaper energy, where they have certainty over what they're going to receive. So we're seeing the third largest economy in the world shrinking, just like the second largest. How about the fourth largest? Well, Japan will grow us out of this. Well, Japan's having problems too. We're in a trade war. Japan's a big exporting nation. They're seeing their exports fall. Japan has a much bigger problem, in that Japan is one of the most indebted nations in the world. Now, many of us tend to think, well, the United States has a lot of debt, and it does, $37 trillion. But if you look at the bottom of that, relative to our total economic output, we're only at 122%. That's bad, no doubt. Japan's twice as worse off. No nation's had this level of debt and survived it. The interest payments alone on that debt will eat up all their tax revenues and then some. So what have they been doing? Well, they've been printing their currency to buy back their debt to send the interest rates down. Well, then we don't have to worry about having to pay the interest on this debt. The problem is now we're seeing those rates are going up. So here we have the Japanese 30-year government bond, and we see the interest rate on that is now at an all-time high. We see the same thing in regard to the 40-year rate. So the Bank of Japan is really at a crossroads right now. They have 2 choices they can make. Choice number 1, they can allow these interest rates to rise and destroy the domestic economy, because if the interest rates rise, they'll eat up all the tax revenues, the budget, they'll have to default, the whole country will come to a screeching halt, economic destruction. Or they can lower the rates, they can buy back that debt, try to lower the rates, print the currency into oblivion the same way Weimar Germany did, and destroy the domestic economy. See the problem here? Japan is a ticking time bomb. Again, it's not a matter of when this happens, or if this happens, it's a matter of when. When is this going to happen? We're starting to see it now. We're starting to see these interest rates rise up. Well, Britt, how about who's left? What's holding this back? Well, the United States, the world's largest economy. That's what's going to grow, right? Only problem is, the only thing that seems to be going right with the US economy is that we have a great stock market, great real estate market, but we just went over that those are in the largest bubbles we've ever seen in history. And when they crash, it's all going to come tumbling down. So what's next? Well, what's next is that crash. So let's take a look at this. This is a chart that shows on the left, all the green figures we see on the left are the biggest up days in percentage terms of the S&P 500. Now, if you listen to corporate mainstream media, they might say things like, oh, the Dow went up 1,000 points today, and it's only done this so many. You have to look in percentage terms, because at one time, the Dow was at 100. Today, it's much higher than that. So in percentage terms, this is more of an apples-to-apples comparison. On the right, we had the biggest down days in S&P 500 history. There's something similar about these two columns. All of these, with the exception of one, coincide with market crashes. So if we look at the biggest up days, well, that was in 1933, the midst of the Great Depression. Top four, in fact, were the Great Depression. Then we have the Great Financial Crisis in 2008. We have the COVID crash in 2020. We have Black Monday, 1987. All of these were associated with those four crashes, except number 8. The eighth biggest up day in S&P 500 history was in April. Where's the biggest down day that coincides with that? Well, it hadn't come yet. But this data tells us it's coming. All the other data we looked at said it is coming. This tells us a crash is coming. And what happens after that? Well, we're going to see bank runs. Just like we saw in the Great Depression, we're going to see bank runs. This is from the FDIC, the Federal Deposit Insurance Corporation. It's a chart of unrealized losses, gains and losses on bonds held by the U.S. banking system. Now, right now, they're sitting on hundreds of billions of dollars in unrealized losses. And people would say, well, that's fine. They're unrealized. They're not real. And that's true. They're unrealized until they are. Just as Silicon Valley Bank a couple of years ago, they had a bunch of unrealized losses. And then when their depositors showed up and said, I want to take my cash out, they had to sell the bonds at a loss, and then the bank failed. For some perspective, if you see that little blip down over on the left part of the chart, that's the Great Financial Crisis. It doesn't even compare to what we see right now. We also see that banks are sitting on massive exposure to commercial real estate. Commercial real estate has lost, in some cases, 90% of its value. These buildings are expensive to maintain. They're often occupied at low rates compared to pre-pandemic. And according to regulators, if you're at 300% or more of your total equity in exposure to that commercial real estate, you're at greater risk of failure as a bank. Right now, we have almost 1,800 banks in this country that meet that definition. They're 300% or worse. And right now, we're sitting at this. So this is the delinquency rate on commercial-backed real estate that those banks are exposed to. It's the highest it's ever been. It already exceeds what we saw during the Great Financial Crisis. So why hasn't this hit the banks yet? Well, because the regulators have said, well, we'll just change the regulations. Sweep it under the rug, extend and pretend. We'll just pretend that they're going to pay you back for a little while longer, and then it won't hit. And I know some people would say, Britt, you're exaggerating this. The regulators, the government, they'll make sure this doesn't happen. The banks have a cushion, right? The banks have a cushion. They have a little bit set aside to absorb some of these losses. Well, how many people know this? So the Federal Reserve changed this during the pandemic. It remains the same. If you read this, it says the board reduced reserve requirement ratios to 0% effective March 26, 2020. Now, what does that mean? Well, that means in the past, they're required to hold a certain percentage of cash on hand for depositors. If they show up and say, I want my cash back, they can go, well, here you go. They don't have to have any now. And guess what? They don't. It's a house of cards. It's a house of cards, and it's going to fall down at some point. And when that happens, it's going to exacerbate something called counterparty risk. Now, what is counterparty risk? Well, that means if I lend money to someone and then they can't pay me back, I'm at risk. That's counterparty risk. So when that goes up, institutions don't want to lend to each other. We saw this very, very briefly during the great financial crisis before we saw these bailouts. So you have a big institution like Lehman Brothers fails, and then everyone they owe money to, the other people look around and say, well, I think that firm was owed money by Lehman, and now they can't get paid back. I'm not going to lend them anything because then I may not get paid back. And so when that happens, when we see counterparty risk go up, credit markets freeze. No one will lend to anyone else because they're afraid they won't get paid back. And that's a big problem, guys, because what runs our economy, there's two things really that run the global economy: energy and credit. To get food, to get a gallon of milk in the grocery store requires the farmer to get credit. He buys the cow on credit. Person who transports the milk to the grocery store does that on credit. Grocery store does that on credit. So when the credit markets freeze, everything stops. So if you think that the pandemic saw a major stoppage, you haven't seen anything until you see a credit freeze. And what that will mean is a bank holiday. And I'm not talking about everybody gets the day off and we'll grill out, right? No, that's not what a bank holiday is. The last one of these we saw in the United States was during the Great Depression. It means the banking system has an emergency shutdown until they hope that they can get everything back in order. And then when they reopen, they sort of cross their fingers and hope that there's not more runs on banks. And in 1933, that's what they did. And FDR said you had nothing to fear but fear itself. And then he crossed his fingers, and people believed it. And it stopped the run on banks. We're heading toward a major financial crisis, the likes of which the world has never seen. And when that happens, well, they're going to offer a solution. They're going to say, don't worry, I know that everything looks like it's lost, but we can restore your retirement account. We can restore the savings you had in the bank that failed. We have something called central bank digital currency. And we'll just substitute that for what you lost. And so we see right now 134 countries and currency unions comprising 98% of all the economic output in the world are either exploring or have launched a central bank digital currency. It's not by chance that all these different governments want the same thing. It's not by chance that when crisis hits, they'll come and say, hey, we've got a helping hand. And there will be a lot of people that'll say, I sure need a helping hand right now. And when they grasp that hand, they're going to find that they've walked into a digital cage. And the door will slam shut on the entire world. They'll be trapped in this digital system. And how does that sound familiar? Well, we read in Revelation chapter 13, verses 16 through 17. It says, he required everyone, small and great, rich and poor, free and slave, to be given a mark on the right hand or on the forehead. And no one could buy or sell anything without that mark, which was either the name of the beast or the number representing his name. Central bank digital currency, even the stable coins we've seen passed under the Genius Act, fit this very definition in terms of capability and function. They're indistinguishable. They're not the mark of the beast. That requires the tribulation. It requires the beast. But they sure put everything in place for it. Under the Genius Act, all stable coins are required to be programmed so that by lawful order of the government, they can be frozen, seized, or destroyed. They want to push us all into a system where they can control who can buy or sell. And we're seeing the infrastructure for this being put in place all over the world. Again, in 134 countries and currency unions comprising 98% of all the economic output of the world. This is global in nature. So I know this sounds dire, but guys, this is the greatest opportunity of our lives. Don't be filled with fear. Be filled with courage. Because again, this is an opportunity. Now, many people come to me and say, how can we prepare for this? Well, outside of what the Bible says to do and diversify, that's all you can do financially. There's something big you can do spiritually. Build your life upon the rock, the solid rock of Jesus Christ. Be in the Word of God every day. When you do that, the storms of this life come, and your house still stands. It will not get knocked down. No matter what happens to us in this world, you'll be fine if you're rooted in Jesus Christ. Many of your friends, neighbors, coworkers, relatives, they're the house on the right. They've said, I'm going to build my life on my career. I'm going to build my life on my retirement plan, my pension, my 401k, my IRA. A lot of those people are going to lose their retirement. They're going to lose their careers. They're going to be devastated. And they're going to look at you on the solid rock and say, all this happened to you too. Why are you at peace? Why do you seem to have this peace that the rest of the world does not have? And when they ask that, you can say, because Jesus Christ gives a peace that surpasses all understanding. And they will be ready to receive what you give them. Make sure you're prepared to share the hope you have in Jesus Christ and to give them the gospel when that happens. Prepare now. Root your life in Jesus Christ and be prepared to share him with those around you and transform their lives. That's all I've got today, guys. Thank you very much.